maybe just to give people a little bit more detail, maybe give us like a hypothetical example of a rail car transaction that you would do, because I'm sure people are kind of wondering, like, how does this work? How do you source the rail cars, and sort of how are they leased out? Who are they being leased to?
So I'm going to paint a little bit of a picture of what the rail market is first.
Okay, great.
So our rail system, I like to think about it as the arteries and capillaries of our economy, right? They're pumping goods and services all throughout the United States and Canada and a little bit of Mexico. And it's a real strategic, wonderful asset. There are about several thousand end users of rail cars. So who we're dealing with are not the railroads per se, though they are a customer, but we're dealing with every sort of company that you come in contact with every day, ranging from ADM and Bunge in the agriculture to Exxon in the energy sector and chemical sector to companies you've never heard of before. What we're providing to them and what they need is a critical asset that's really a part of their infrastructure. And without these assets, their facility, their agriculture, their chemical plant can't function, right? So it's a critical asset. The reason why people lease it from us for various reasons, but the industry in general is a leased industry. What we're trying to provide for our investors through this structure and through the structure of the industry are a good long-term stable cash flow, right? That's number one with what we're trying to do. Right. And the second, it's an uncorrelated asset. So stocks may go up, bonds may go up or down, but our assets should kind of be steady and moving along. The third is an inflation correlation. And then the fourth is great downside protection. We do all of that through a couple of key characteristics of the asset class. One, our contracts and our customers are leasing assets on long-term contracts. And they're a lot like your automobile lease. They're considered a take or pay contract. What that means is they have to pay no matter what, whether they use it or not, right? Whether you park it or don't park it. So that helps us start building this long-term flow of cash flow. The second thing is these are relatively cheap assets. So an average new rail car costs around $100,000. A 35-year-old 40 rail car could cost $10,000. They last for up to 50 years. So it's a very small, so it's a critical aspect, but it's a small cost and part of the supply chain. Our leases will range from $100 to $2,000 per car per month. On average, it's around $700-800 per car per month. To move something that in finished form could be worth several $100,000 to upwards of several $1 million. So again, critical infrastructure, low cost. And then finally, these assets are relatively in high demand. Supply and demand is fairly balanced, and it's generally supply constrained. What I mean by that is almost no rail car is built on spec. It's not like you can an end user can show up at the rail car manufacturer like you can at your auto dealer and say, "I'll take that one in red." Right. You gotta order in advance. There's usually a backlog. So again, now you have a little bit of scarcity in the asset class. That's the rail car market in general.